All right, I think we're going. This is the April 2022 market update. Currently looking at the 11 sectors of the economy. Right now, we can see that in our basket of stocks, 70% of everything is above the 200 and above the 50. That is a fairly large number. So that means that the market is doing really well right now. Taking a look at the basic material sector, we see that they are right in line with the rest of the market, doing a little bit better on the 200-day, but basically in line. Communications, I think this is very telling. Over the 200-day, not doing well at all, meaning that these stocks are not doing as well as they have done in the past, but they are doing much better than the rest of the market currently. And so I think that says something to where the consumer is, where it's not as great as it once was, but it's getting much better. All right, cyclical sector, and this one is pretty much all consumer confidence, not doing great at all over the long term. As you can see, the 50-day is right about where the rest of the market is. So again, just like with the communications, just again not doing as well as they have in the past. Defensive sector, right in line, 68, 74%. Nothing really to talk about there. That's to be expected. Energy has been the talk of the town, and it is just crazy to see. I mean, month after month, the energy sector is 100% over its 50, 100% over its its 200. All of these companies in the sector doing really well. This is where the money is flowing to. When that tops out, I don't know, but clearly it cannot stay at 200. I'm sorry, it cannot stay at 100 forever because at some point the energy sector is going to be um, either expensive or cheap relative to itself. Meaning that right now that 100%, 50, 100%, 200 is based on information from a month, 2 months ago. What happens in the next month or two when energy stocks are compared with where they were right now today? And so I imagine that at some point we're going to see those numbers start coming down, meaning that the energy stocks are going to come down as well. Um, we just don't know, when that's going to happen. But like I said, last 2 months, everything above the 50 and 200. Okay, so financials. This has been a really surprising story, I think, for everyone. I have not kept up with the talking heads on this. That may be something that I go back and do just to see, what popular media has to say about this. But um, I'm certain this has everything to do with the interest rates. We thought that we were going to see interest rates hikes across the board. I think they were predicting like four hikes in 2022 back in 2021. That has not happened yet. And so I think the financials have definitely suffered because of that. And so I don't think this is so much a consumer thing as we see in the cyclicals and the communications, but definitely more of a interest rate thing. Almost worst performing sector, by the way, 42 and 25. So keep an eye on that, see if we get anything worse. I don't think we will, though. Health, again, right in line with the rest of the market. 80 and 60 is about there. Not doing as well, I guess, as basic materials and whatnot, but really right there. Industrials, again, pretty much right in line with the rest of the market, doing a bit better than what they have done in the past. I think this has everything to do with the current war situation going on because a lot of these industrial companies are going to deal with machinery and military defensive systems and things of that nature. Real estate, right in line with the market, maybe doing a little bit better. Really excited to see that because real estate is as much about the consumer as it is about interest rates. And so I think this says something to the financial sector. right? If you have real estate, which it basically makes its money on being able to borrow cheaply and and loan at a higher rate, but also too, it has to have the business. People have to be either consistently paying all of their mortgages and leases and rents and things like that on time. You have a heightened um, real estate market where you have like a lot of demand, and so prices are going up because of that. Or a positive is also you don't have people not paying their bills on time. You don't have people not, I'm sorry, you don't have people um, selling because they can't afford to keep it up or they're selling at a loss. Like, so, again, that just for me reiterates the fact that the financial sector has nothing to do with the consumer and everything to do with interest rates. All right, technology. Yeah, so financials are doing the absolute worst, and that makes me feel really good based on our current position in Regions Financial. We are down, but we're not down a lot. And if you're telling me that Regions Financial is holding 20 and the financial sector is in the worst shape it's been in a very long time, that's a good thing. So, anyway, technology, not doing well at all. Again, this goes back to um, the consumer, right? When things are doing really well, people tend to upgrade their electronics and buy more electronics. And so um, clearly, you know, clearly things aren't super fantastic, great. Um, but I don't think they're very bad either. And I don't think this has anything to do with supply chain. That has been the story for a very long time. And throughout that entire time, the technology sector was doing just fine. So now that we see this huge drop off, I mean, 77% of these companies are below their 200-day, means that they've just come way back from where they once were. But the 50-day is in line with the market, so that means that there's nothing really going on really with the technical the or software companies. It's just that they aren't doing anywhere near what they were doing before. And I think that's because maybe the supply chain story bubble has popped. I think they were, anytime that there was any loss in revenue or a loss in profit, there was always this, well, supply chain, supply chain. I think they were given the benefit of the doubt. And so now I think maybe that bubble has popped and people are starting to see these companies for what they really are. And that's the reason why we have such a steep drop off. Utilities, again, we could talk about government in this case, but I don't really think that's a story, right? For the most part, utilities is going to come down to consumers. And so when consumers are able to pay their utility bills, we won't see any trouble out of the utility sector. And, you know, they're second in line behind energy, which is interesting because typically utilities um, purchase oil to generate electricity. So I'm not quite sure why utilities are rising with energy because they don't really do the same things. But either way, that's what's happening. So let's take a look at some of these names here. Looks like ETR, where we are, is sharing the, um, the MVP category with a few of these other guys. As far as the monthly average return, I'd say it's very close to being sector average, very close to being sector average. So that's a good thing. In technology, we're currently in Corning, which is a second MVP runner-up, but really, again, really splitting time with everyone in the group. And then as far as monthly average return, it is a negative, almost the worst performing for the sector. So that tells me something, right? So when we look at potentially purchasing more shares, we're going to really be paying attention to maybe competition. and their peers, and seeing why it is that they're performing not as well as a Hewlett Packard where we were before, right? Okay, real estate. Again, very interesting sector here. MPW overwhelmingly is the sector MVP. Um, and then we have Macarich, which happens to be one of our orphan shares that we've held since the beginning or since the inception of the fund. Um, yeah, everyone is about 2, 3%, and so MPW is at the bottom of that list. Um, so not great news, but again, I want to reiterate, it is the sector MVP, meaning that MPW just so happened to be in the best performing portfolio over the last 12 months, more than any other real estate company in the sector. And so while the company itself may not be performing uh, great, it means that this type of company has been performing well overall for whatever reason, just not in the real estate sector. All right, let's look at industrials. Very, very short list this year. Really curious to see what happens on our next fiscal year. We'll be reshuffling all of these companies in June and July. I've said this before. If we run into a situation where we only have like maybe three industrial companies to choose from, we will have to very seriously consider investing in the corporate bonds versus the corporate equity. All right, so EMR, IEP sharing the sector MVP duties here. Paychecks is where we're trying to get into. As you can see, best leading performer of the sector. And this 15% that we see here last month is the reason why we were not able to get into this position because the price shot up so quickly. We see Fastenal, Paychecks, and what's this other one? Yeah, so Fastenal and Paychecks were the only real winners last month. Looks like EMR came up a bit too, but everyone else um, has been losing over the last couple of months. All right, healthcare. Another sort of short list here, but Merck is the overall leading MVP, but really, kind of sharing duties with everyone in the sector. Looks like Organon is very close to being, oh, I'm sorry, no, Pfizer is definitely a sector leading performer, followed by CVS, which has performed really well. Been really keeping my eye on that one for the last couple years, actually. So that's interesting. So far, so good. I mean, most of our holdings are sector MVPs, and I want to say here that we do not choose um, our portfolio based on um, sector MVP primarily. Yeah. So that's really cool. All right, financial services. Blackstone has just been a beast for the last at least 3 years, um, in almost every category. Sector leading MVP, best sector performance for monthly average return. I mean, 5% is just that's crazy. That's crazy. We're currently in Regions Financial, which is nowhere near 5% a month. And as we can see here, really kind of fell off quite a bit. I mean, we're talking about a 10% drop in the last 2 months. And then we had a 9% gain the month before that. So that makes sense as to why we're really just back at zero at this point. I'm looking at some of these numbers, and it appears that the insurance companies looks like they gained quite a bit. Um, and then looks like the banks didn't do so well. And so again, that just strengthens the story concerning interest rates. Um, all right, energy, it's a large group here. Valero sector MVP, but again, really kind of spreading itself around, or I'm sorry, really a bunch of other companies are MVPs as well. So can't really say much about a 4. It's 4 out of 12 months. But I would say roughly, well, on the lower end of sector averages here. So not the best performer by a stretch, but definitely not the worst. Looks like IMO, the Canadian Exxon, um, kind of just beating everyone out there. Yeah, 4% for SU. So, I mean, again, not horrible. We'll definitely look at some potential replacements. I know I looked at IMO for sure a couple months ago. All right, consumer defensive. So again, kind of sharing duties for the MVP category. We're currently in Campbell Soup, which is posting a negative average return, uh, which is not great. You know, we want to see that average be positive. It means it's gaining every month, not losing every month. Best performer looks like ADMBG. Don't know a lot about those guys. But again, we're kind of happy with where we are with Campbell Soup. We'll continue pocketing those dividends and options premiums. All right, consumer cyclical, which I think was a larger group last fiscal year. Not entirely sure, but now that I'm looking at it, it's kind of a short list here. Best Buy overwhelming sector MVP for whatever reason, but definitely not the best performer. Best performer goes to GPC and PKG. Interestingly, PKG, I believe, does about the same work as International Paper IP, where we were. And so why PKG is performing so much better than IP, I'm not sure. I'm sure it has a lot to do with management, but that's sort of my observation based on only looking at the quarterlies from IP. So anyway, out of that position, we'll be looking at getting a new position started. We will for sure look at Best Buy because it is sector MVP, but we'll take some other things into consideration as well. All right, communication services, AT&T, sector leading MVP has been the case for I think a number of years now, actually, but almost always the worst performing stock in the sector. So that's really interesting. Best performance goes to TELUS and IPG. And so we will definitely, well, wow, wait a minute. No, Rogers at 177, just barely beating out IPG. So, yeah, so TELUS and, yeah, so all these guys are about the same. So we'll just call it industry average here. And so I think that's telling too, because, you know, you're talking about trying to replace a stock with another stock. And the question is, well, why replace it, right? Like, what do we stand to gain by replacing this position? And I do remember looking at TELUS. I'll have to go back and look at that video again, but we're not going into TELUS. BCE is actually a position that we held many years ago. I'm saying many years ago, probably a couple years ago. Really decent company. It's basically Canadian AT&T, and it looks like the performance is about the same. So I don't know. We'll just look at this again and make a decision to stay or go. All right, basic materials. Again, just like a lot of these sectors, really spreading the MVPs around. And so I think that means that we're seeing anytime that you have a different company in the best performing portfolio, typically what that means is that the market is sort of all over the place. Either that or all of these companies are very similar. And I don't think that's the case. I think almost every month we're seeing a different type of portfolio beat out everyone else. And so we'll look at that here in a second. Looks like Southern Copper is we're gonna call this industry average. The reason why is because CF just blows everyone out of the water. But From my recollection, CF is not investable for us. Matter of fact, these bottom four are not investable for us, and that's the reason why they have zeros in their MVP categories because they can never be on the best performing portfolio because they never meet the specifications to be an investable company. So, um, really, truly, all these four companies at the top here really do. 1 month it may be AM that's performing better. Next month it may be Southern Copper. So we're happy with Southern Copper. Not really seeing a reason to move from there. All right, let's take a look at the best performing portfolio thus far. This is the last 3 years. So this is assuming that we purchased these particular companies in, I believe, June of 2018, and we simply just held them. We didn't sell anything. We didn't make any money on options. All we did was buy and hold. Okay. If we bought and hold, if we bought and held these companies from June of 2018, we will have returned 80%, which is really good when you're talking about 3 years, 80%. That's really decent. But what I'm more interested in is what are the portfolios in the top 10, top five, right? And so just at a quick visual inspection, we see down standard deviation, of course, is top of the list, right? But then we also have, which is really, really interesting, dividend and return. Typically, you do not see a dividend portfolio in top of the list because typically the dividend companies are what we call dogs of the Dow, meaning that their dividends are so high because the stock price has come down so much. And there's a theory that says those are the best companies to invest in because you're guaranteed to get them at a cheap price. But that doesn't always stick because, again, sometimes the price is cheap for a reason, right? So it's really interesting to see that the dividend return portfolio has performed so well. And then we have these M-score portfolios up there. And then again, we have another dividend portfolio, really interesting. Down moves, again, right in line with the down standard deviation. Alpha down, so again, we have the down. Again, standard deviation, we've talked about that one. M-score again, M-score again, M-score again. So for me, this means that we're going to be looking at companies in these portfolios, and we're going to be looking at some of the differences, but also the congruencies between these portfolios to try to determine what the market is telling us. And I can say too, before we even get there, you know, and I've said this before, the down portfolio is something of a defensive portfolio, right? Same thing goes with standard deviation. It's a defensive position because these are companies where the price doesn't move around a lot. And so when you have a market that has a lot of volatility going way up and going way down, typically that standard deviation portfolio is going to perform fairly well because when the rest of the market is going crazy, this portfolio is just like, nope, staying right there, right? Again, I talked about the dividend portfolio, but never in depth. And so I'll take that opportunity now. The reason why we can see a dividend portfolio perform really well is because those dividends must be off the chain, right? Those dividends are probably going to be somewhere in the 9 to 10% range, which is awesome. Just imagine that you can put your money into a company and you can consistently every single year bring in a 10% return and you don't have to do anything. That's pretty good. And then the M score, I've talked about that at length. Again, that's a very defensive position. And then down moves, meaning that, and I've said this too much to talk about it longer, but yeah, another defensive position. And then even we see beta creeping here one time, right? Which means that this portfolio performs best when the market is down. All right, so let's look at the last 12 months and let's see just how much this changes. Okay, last 12 months, rolling 12 months. This is going to change every single month because every month, old month gets dropped off. Okay, so this is very current, right? And as we can see, currently, all of the money is going into alpha. I mean, look at alpha is in everything, right? We have a straight up return portfolio here, a straight up moves portfolio here, which is the opposite of down moves, okay? But everything is alpha, alpha, alpha. So, and then I love seeing the standard deviation down here at the bottom. So again, when there's a lot of volatility, that portfolio is going to do well. So what we're looking at here is clearly a move from more defensive positions to a more aggressive, let's get out and go type of portfolios that are currently performing well now. Okay, let's look at the worst performing portfolios currently, and so we expect to see the dividend portfolio in the mix. Down moves is something that I think is a bit surprising, but makes sense based on what's performing really well, right? Um, Also, too, I think it's really um, kind of a flex here. Let's go back and do this again. So if we look at the best performing last 12 months, the top 10 are all double digits, right? All winning. And then when we come back on the negative side, there's only one that's double digits. The rest of them are like, yeah, we're the worst performing, but we're still bringing you 1% a month. So, I mean, as far as losing money, it'll be very hard to do so with this basket of stocks, which is really cool to see. But again, we see a lot of dividend, a lot of down moves. Um, yeah, dividend down moves. Right. So currently the down moves, which is the portfolio that we're following, is not the favorite. And so um, we have to be careful though, because the down moves portfolio is what we're following, okay? Because the long-term trend says that that's what's working. And so what that means is if we follow this down moves portfolio, it may not be the best performing right now, but long term, right? Meaning that if I just had to walk away and I wasn't able to make any trades, if I wasn't able to manage this thing, if I wasn't able to do anything with it, and I'm just stuck with the companies that we have now, these companies will have been following that down moves portfolio that over a long term has done really well. And so, we imagine and we can make some assumptions that it's going to continue to do well, even though it may not be doing well right this second. All right, let's take a look at volatility. I expect it to be really high. I don't have any historical data on this. Just kind of curious to see. Um, so it looks like the worst month was down. I'm sorry, the best. Oh, this is so grammatically difficult. The best the best loss of of the last 12 months um, was an M score portfolio. So meaning that when these portfolios did lose, right, how bad did they lose? And so the M score, again, a defensive position, did the best. But then we see this return alpha here, um, really right in the same neighborhood. So let's look. We got M score, we got alpha. Dividend is a shocking one, but not so much because even when the company loses money as far as the stock price, that dividend doesn't change. And so you're consistently making money with that dividend. All right, so beta return, beta, 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 of course, beta, beta, beta. All right, so yeah, I mean, outside of the beta, which you would expect, um, the return in alpha is the most interesting one here. It really is. All right, so now let's look, because you expect the return alpha to be the most volatile, right? So let's look at the worst performing. Oh my goodness, look at that. Down standard deviation. My goodness. Down moves, down. I'm just seeing down, 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 a couple dividends. Yeah, so it's just that down portfolio is just not doing well at all. So I'm really curious to see what the differences are between those portfolios. Um, let's look at the highest return down moves, of course. And so we're talking about volatility. So what that means to me is that the down moves portfolio has the most volatility. What can cause that, right? So down moves has to do with volume, has to do with the amount of shares being traded. Okay, that's how it's calculated. And so anytime that the volume is higher than average, that's how I calculate this. Anytime that the volume is higher than average, the question is, does that stock price move down or does that stock price move up? Okay, so what that means is that if everything is normal and people are trading the same amount of stocks that they always trade, um, in that case, we can't really say anything about the down moves portfolio. It really does nothing for us. Okay, if persons are trading a lot less than what they have been historically, again, that doesn't really say anything to us as far as that down moves portfolio. What it does say, however, is when something happens in the market, and this can go both ways, right? It can be people are scared. It can be money is moving out of the market to other assets, to other investments, such as we know that's happening with cryptocurrency, where if someone says, "Hey, here's $100," right? You have a choice to make. Do you put this $100 into purchasing real estate, right? Do you put this $100 into purchasing crypto? Do you put this $100 into purchasing Jordans? The point is you have choices, you have options. You buy stamps, coins, like where do you see the most value for your money, right? And so when money goes out of the financial markets, out of the stock market, um, then trading volume is less. Okay, trading volume is less. And like I said, with this particular portfolio, um, that won't really help us much. What it does calculate, however, is what happens when there's an abnormal amount of volume going into it. And so sometimes that can be people scared and selling a lot of their shares out of the market. Sometimes that can be the fact that the market has done so well that people are selling a lot of shares to pocket profit. It can be that people are really excited about the potential market returns, and so they're buying more shares. It can also be that there are issues with those alternative investments, and I'm saying alternative. They're not really alternative. They're just alternative to the stock market, right? Such as the real estate, such as the cryptocurrency, and those things. And so they're taking money out of those boxes and then putting them into the stock market. Um, right now, today, we know that money has definitely moved to crypto. There are numbers out there, there are studies out there. I have not read any of them, so I don't know. But I can imagine that a lot of the persons going into crypto, and I'm saying a lot of them are coming out of the market going into crypto. Um, but then there's a lot, I don't know how many, that have never been in the market um, that are going into crypto. So maybe the reason why this down moves portfolio is so volatile right now, it's so up and down, is that the volume is either steady, meaning it's not really moving around much, or the volume is a lot less. Um, and if you pair that with the fact that the return, the alpha portfolios are performing so well, that tells me that money is clearly going into those positions because that's the only way for those portfolios to outperform is if people are buying those stocks that are clearly performing well when the market's performing well, right? Um, so that means that volume is not like way up. People aren't super excited about putting their money into the stock market. I think there are other things that has captured um, the market's attention as far as investments go. And even though clearly money is still flowing into the market, I don't think it's flowing in um, as much as maybe it has done. So again, very volatile. Um, the most volatile, actually. Let's look at this again. Oh wait, wrong button. I always get the smallest and yeah. So 10%, 18%, and here's the other one, 9%, 20%. So they're. I mean, they kill everyone. So you can make the most money out of these portfolios, and you can also lose the most money out of these portfolios. That's the definition of volatility. Really interesting. All right, so let's take a look at some of these portfolios and just see, like I said, what the differences and congruencies are. So looking at down moves, just because it's here, um, we see that IVZ, which we've seen in the past, purchase price of $10, $11, currently sitting at $21, and it just happens to be the top position for this particular portfolio, followed by NWL. Haven't seen much of that. CAH, haven't seen much of that. Mackerich, we know that one. Valero, IP, EMR, Corning, EMN, PPL, and then AT&T. And so I'm looking at kind of where our portfolio is and what this one looks like, and then just to see what the number is down here. All right, yeah, so 64%. We see that the actual dividend is 11%. That's crazy. Let's take a look at the dividend portfolio now, because if the down moves is 11%, the dividend portfolio must be bananas. Let's see, actual div 18 per, oh my goodness, almost 19%. So this means that you purchase these companies and if you purchase these companies in June of 2018 and just held them, you're collecting 18%. Um, that's that's really good. All right, so let's see. IEP, International Paper, of course, NLY, Annaly, AT&T, of course, MP, don't know much about them. CNA, don't know much about them. IBM, Southern Copper, PPL, WBA. So the only two companies um, is International Paper, which we're out of though, and Southern Copper. So I'm really happy to see Southern Copper in that mix. So that means that we're getting a really great dividend out of them. So that's really cool. All right, let's take a look. Not interested in beta. Yeah, the return alpha, interested there. So NEM, INTC, Blackstone, of course, Best Buy, really interesting. MPW, we're there. Merck, we're there. GIS, and then Tullis at the very bottom here. So yeah, and I know Tullis is, like I said, the sector leading performer in that communications sector. So not not surprised to see that there. So yeah, interesting. I mean, out of these companies, we have Merck, and we have MPW, so that's really good to see. Consumer cyclical, we do have to replace International Paper with something. I don't know if we go back into Best Buy. We just came out of Best Buy. Um, and yeah, so all right, let's see Alpha now, and then we'll do maybe Return Alpha because I don't think there was not a pure alpha portfolio that really did very well. But Valero is there, Blackstone again, Best Buy again, Intel again, EMR again. AEM is different. CVS, GIS again, MPW, and then TELUS again. So, we're seeing some of these same companies pop up again and again. And again, this is how you can have something like a Best Buy that winds up on 7 of the last 12 months being the best performing portfolio, probably because it's in so many different portfolios because it ticks the boxes of so many of these portfolios relative to the other companies in that group. So that's interesting. But again, really good to see Valero there as far as return and alpha. Lets us know that we're getting bang for our buck there. Same thing with MPW. That's really cool. All right. I've seen Intel quite a few times here. Up moves, not really concerned about up moves, even though that can be a thing. Okay, standard deviation. Um, this one is completely out of left field, it seems. So RY, don't know anything about them, but they hold the largest holding in this portfolio. Looks like purchase price is 68, current price is 100. So that's quite a big jump there. Um, Tullis again, just really killing it in that return and alpha game, but also not moving around a whole lot either. Coca-Cola, we've seen them perform really well. FTS, don't know anything about them. IBM again, don't know much about their. Pfizer, we know them; they're doing well. GPC, we know they're doing well, so that's definitely a potential candidate to us to get into. ENB, Annaly for real estate, Raytheon for industrials, and then NEM all the way at the very bottom as far as allocation goes there. Okay. No, not interested in really any of the dividend portfolios. What is this one? Down. Here's another portfolio that's almost never on any list whatsoever. And I did this really just as a statistical control um, to see and make sure that the numbers matter, right? And I'll explain what I mean by that. In statistics, you can divvy up numbers and you can add so many variables to the point that none of your data um, makes any difference. Meaning that if I were to have 1,000 portfolios and if I were to assign all these different variables to these portfolios, um, if in fact I can simply just take an average of all the portfolios, okay, and if that average portfolio number does as well as one particular portfolio in the group, then that means you don't really have a system of prediction. What you have is just a bunch of numbers that all equal the same thing. And so that's what this portfolio is for. And I almost never ever see this on any list at all. Um, I am curious though as to what the 46%. I mean, yes, I mean it's something, but um, nowhere near the best. But also not the worst either. So again, that means that this is what it's supposed to be, which is just a statistical control. Doesn't do well, doesn't do bad, and that's good. It means that this thing is making sense. All right, beta return, beta alpha. Now, I'm not interested in the beta stuff, because clearly alpha is where it's at currently. Okay, there we go. Return alpha, Blackstone again, Intel again, Best Buy again, AEM, OKE, that's different. MPW, wow, I'm seeing EPW on a lot of stuff. EMR again, Merck, okay, PEG, GIS, and Telus. So yeah, I mean, when you talk about return, you talk about alpha. They're pretty much all the same with a few differences, particularly this PEG and OKE. The rest of these I think are pretty much the same. AEM is different as well. So that's really good to know. So that means currently, again, we're talking about specifically something like a Blackstone, an Intel. a Best Buy, an MPW, a Tullis. These are going to be the names that's really working right now. Whether or not that will be the case 12 months from now, I don't know. But right now, these are what are working and what has worked. I think this is interesting because standard deviation has done so well. NEM again, basic materials, Intel again, Blackstone again, Best Buy again, MPW again, Merck again, GIS again, Telus again. So there's no question. There's no question. There's going to be some small differences, right? So we see utilities, and I think a lot of reason for this, and I said this I think in a previous video. Some of these companies, the reason why they're being able to they're switching out so easily goes back to those sectors where you had the entire sector sharing MVP duties, right? Meaning that the sector may be doing so well that it does not matter. You can pick any company in that sector and you're gonna do well, right? And energy we know for sure is one of those sectors. Like it really doesn't matter. If you purchase Valero, if you purchase MMP, if you purchase IMO, if you purchase OKE, if you purchase any one of those companies back in June of 2018 and you held them till today, you're doing great, right? Um, but when we see these consistent names, that's when we know that we've really hit on something, right? And so Blackstone is a big one. Intel again, Best Buy again, MPW, Merck, GIS, and Telus. And GIS, maybe not. All right, Alpha Up, no. The up moves was there, but not really. Alpha Standard Deviation. This one I don't think made the list, but I think it's interesting just to look at. Again, not learning much out of this other than the fact that again we see these same names: Blackstone, Best Buy, EMR. I think has been there quite a bit. GIS again, MPW, and Telus. All right, so let's get out of that. I don't think we need to look at that any longer. We pretty much know right now what's working as far as the return and it goes. No need to keep going down that road. All right, M score. This is an interesting one. And I said this before because I never thought that this particular portfolio was going to mean anything, but I did create it just um, just because I thought it was interesting, right? And just to kind of see what would happen. And sure enough, it's turned into a defensive play that I did not think of. And also too, I want to say all these portfolios that you see me going through, um, in the case of like a huge fund, right? All of these particular portfolios will be options for persons to invest in, right? So you'll have like a mutual fund that'll have all these different portfolios that you can say, okay, well, I want to put my money in this particular portfolio or that particular portfolio. And then each of these portfolios would have a portfolio manager that will be responsible for managing this thing. The really cool thing about what we're seeing here is that these portfolios are not being managed, right? And a lot of the reason for that is because the theory is that the more you mess with something, uh, the more possibility you have of losing, right? And so the idea is to be hands off, let the computer do the work, and you'll come out much better that way. I have found that it is necessary, and I'm sure this is the thoughts of many, that it's necessary to have human oversight. It's really cool that you can design these programs and things of this nature to run without aid. And if it's designed well, you can allow it to just run without aid. And that's the purpose of this. But I do see where human oversight is needed in some cases, where the computer just doesn't understand the nuances of maybe current climate, right? As far as what's going on in the market, or the computer is so reliant on past numbers that it can't see what's happening right now, and so I do think it's important to have some sort of management over it, but also to be as hands off as possible. And that's a lot of the reason why this particular Texas Vestments fund or portfolio rather is only managed once a month, right? I don't want to come in here and mess with it every week. I don't want to mess with it every day. It's purposely once a month. And then there's some months that get skipped. There's some months that I don't do any management at all. I don't do anything. I just let the portfolio do what it does. Um, the one thing that requires management is the selling of options. That is something that you can set and forget, but at some point those options are going to expire, and you're going to have to go in and sell more. It is possible to do long-term options, but I don't like long-term options because it forces us into having to hold a position long-term. And what I always liked about the stock market in particular, or the financial markets, is that at any time you want to, you can basically sell your position for cash, no questions asked. You can't necessarily do that with a house, right? I mean, it can be difficult to sell a home at a profit, or even for what you purchased it for, quickly, right? With stocks, I can sell it same day. And so um, that's that. All right. So the M Score portfolio, Regions Financial, where we are, Best Buy, Southern Copper, um, Philip Morris is a brand new one, MPW. Organon is not supposed to be here. Um, that's interesting. I'm going to have to. Really thought I made this change already. This is not good. Organon's not supposed to be there because it's not investable. Um, so I'll make that change and look again. But either way, not really. Okay, not really a big deal because so far we've only seen it once, and we know for a fact that CVS and those guys and Pfizer and stuff like that are really killing the game. All right, so again, Best Buy, Southern Copper, and MPW for the most part. Um, Regions Financial is where we are now, and it's actually the largest holding in this M Score portfolio. So that gives me really great confidence in that position. Um, and again, just to go back, I mean, if you purchased this Regions Financial in June of 2018 and held it, it's worth $20 today. So that doubles your money just out the gate. Let's go to dividend. No, no betas. I am interested in the alpha and the return though, just to see. Okay, Best Buy again just ticks all these boxes. Cisco again, part of that M score. Um, see who else we have here. MPW again, Tullis again, and so that pulls in this alpha idea along with the um, protection of a really great management score. NEM we've seen quite a bit in basic materials. So okay, so again, what I'm really looking at here um, is the Tullises, really looking at the Best Buys, um, Intels, for I don't know, and score standard deviation, sort of maybe. I mean, we know standard deviation is doing well. Regions Financial again. I don't think any of the other banks can really compete with Regions Financial when it comes to that M score. Again, that gives me really great confidence with where we are. Best Buy again, Southern Copper again, MPW again, and the rest of these guys. I think again with like utilities, you can probably pick any one of them and you'll win. Same thing with energy. You can pick any one of these things and they'll win. OMC, we've seen quite a bit in communications, but I think Tullis really kind of beats out everyone in that regard as far as performance. There was another portfolio. that I discussed, and I don't remember which one it was. This one's kind of interesting. Return Alpha, kind of the best of all three worlds here. Best Buy again, Cisco again, Blackstone again, Valero, MPW, Organon again, is not supposed to be there. EMR, I've seen that quite a bit. GIS, seen that a lot, and then Tullis. Um, so I think this is really going to help make a decent decision on where we need to be, and again, how we go about allocating um, our cash now. So let's look back at this. I want to make sure that we didn't miss anything. Um, Dividend return. I guess we can look at that one, but I think we'll be okay. M score. We looked at that. Okay. Down moves, four. And then this one, I know it's going to be all return alpha. Yep, there's that M score return alpha. Sure, all those are going to be about the same. All right, let's look at our color chart here. The best performing portfolio for April 2022 was down moves. Look at that. This happens to be the portfolio that we're following, and it was the best performing portfolio this last month. Let's see what's in there. Again, we got CAH, got Corning, MLR, IVZ, International Paper, Macerich, PPL, and then AT&T. Okay. And it looks like, see, that was like 5%. So it looks like everyone did really well because even like the dark red is only uh, barely zero. Yeah, everyone did really well this last month. And so sometimes I wonder if you can learn really anything from, oh no, wow, see these way in the red. M score standard deviation. That's interesting to see. So over the last month, the the same thing that has worked seemingly really well has not done very well at all. Let's take a look now. Wow, all these M scores. I'm curious now. So let's look at like the alphas and stuff. So uh, alpha up 4%. Yeah, alpha standard deviation 3%. So 3%. Okay, not bad. And so the return, all the return portfolios really well. 3%, 4%. Betas, of course, didn't do very well. But when we see this equal portfolio here at 4%, pretty much means everyone is about there. And the down moves portfolio just outshined everyone basically. But even the dividend portfolio was up 3% this year. And over the last year, it's been a horrible portfolio to follow. Um, see what the average is. Yeah, average is negative. But I guess it's important to note that it's negative, but it's also zero. So, so it hasn't made anything, hasn't really lost anything. All right, and then let's look too at our 50-day, 200-day trend. I think this is interesting because again, we won't be able to really know anything based on this um, for at least another couple years. But it's interesting right now because the highest the 50-day has ever been um, was 77%, and we're currently at 71. So I'm really curious to see um, how much higher this 50-day can go, and whether or not at some point we're going to notice that 50-day getting to 80 and then dropping, right? Um, it's also possible that it can get to that 70 and stay there. However, that's going to be really difficult because again, that 50-day is comparing itself to only 2 months ago. So if the prices stay elevated at some point, they're not going to continually elevate. At some point, they're going to level off. And so we'll see that number come down. So again, really interesting. The 200-day, we've seen it as high as that 82%. And so again, we're kind of right there. And so I imagine we're going to see a drop off here in the next month.